I want to start out with a little bit of psychological discussion here as why the markets are going higher and why people who are catching the wave correctly and why people are not. So I get a pretty good feel, I think, for the Twitter stream. I have a decent following on there. I have a lot of people who communicate with me regularly. Over the years, I've developed my own fade list. I don't really refer to it as much as I used to because I'm trying to be a little bit more kind-hearted. But I do have a group of people I follow who pretty much make the wrong decision. You could count on it. I mean, you could set your watch to it. And between that and a lot of the messages I've been getting, it seems to me that people make this, and I guess it's just human nature. They get fearful when they have a gain to lose the gain, and then they get hopeful when they have a loss that they'll recapture the loss. And in my experience with successful trading, it's really actually just the opposite. You should be fearful that a small gain will become a big gain, not hopeful that it will reverse. And hopeful that a small gain will become a big gain, not that you'll miss out on your small little gain. Because if you're going to make some big returns in the markets, you need those, those runners once in a while. And that's not to say that it's not okay to take profits along the way. I mean, I do that. I mean, that's prudent trading, but I find a lot of people are careful mics. They tuck their $7 profit, 7-point profit, and then they miss the 40 points, the big move. So kind of keep that in mind. I think a lot of people are also making the mistake of trading out of season. They're trying to force the markets to pay them when the markets are not wanting to pay them. Meaning that in 2013, you had a trending up tape, great market to trade in size and to play the trend is your friend. For the last, since then, 2 years, almost 3 years, you've had a very choppy sideways market. And I think people have not adjusted their trading styles. You're playing for shorter moves, smaller moves, shorter time frame, and maybe not looking to trade in as much size. I kind of go back to baseball here. It's more of a singles and doubles markets than, let's say, a home run derby like it was in 2013. And I think people maybe have not adjusted. That seems to be the cause of a lot of issues. I think people are also missing the overall trends of the tape, that the trend is your friend. Since the election, we've had a fairly uptrending tape, and I think that the idea of a tax cut and more competitive United States has got the stock market doing well. You also have some seasonality here. It's the end of the year. A lot of portfolio managers, big money I'm talking, have underperformed the tape. You can see with some of the hedge funds, they've had some pretty abysmal returns, and I think that they're now chasing those returns. In addition, if there is some tax reform, I think that a lot of people are waiting to lock the gains in next year, one, for potentially a lower tax rate, and two, to kind of have the years float to pay it off, so they won't have to pay it off this year. That's an important point. Anyway, a couple of the messages I get, and I don't want to single, again, this is not singling anyone out. I get if you guys saw my DMs, I really honestly could use an intern or someone to just go through and answer or at least flag some of them. Believe it or not, a lot of the answers I just wind up copying and pasting because I get so many of the same question. So that's always efficient, though, because at least it saves me a little bit of time. But I've been getting a lot of messages. When is it the right time to short IWM? When do we short SPY? When do we short this? When do we short that? And I'm just amazed that the market is making all-time highs here, and people are still looking to fight. They're looking to fight the tape. And I'll say this. I'll keep it simple. The traders do what works until it doesn't, and you just had a market that broke out, and you had a couple of days pullback. And I think I emphasized this pretty well in my weekend review video, where you had a few days of pullback and it was on very weak internals. You had almost sort of trending days, kind of narrow ranges with 2-to-1 negative internals. and everyone's now loaded up short and terribly bearish. That's not a bear market. That's just a pullback. Consolidation at the highs, very healthy. And I had pointed out that you could even have had a pullback as deep as 217 on SPY, and it would still be a buy, because this was basically the check back range between 217 and 219.60, I want to say. So what amazed me is that people were looking to kind of try to top pick to play for the little pullback, as opposed to playing in the main move, the main direction. Now I'll say this: a lot of I notice very often people overtrade. They kind of they try to play every move in every stock every day. I mean, we're here, we're watching the market. It's tempting. You want to be involved in the action. You see things moving. But I try to take more of a methodical approach to it. Like, for example, this is a great example that I actually took out of Reminiscences of a Stock Operator, which is pretty much my Bible in terms of trading. If you haven't read that, by the way, it's about Jesse Livermore, and it's written by a gentleman named Edwin Lefebvre. Fantastic read. There's actually a follow-up book to it as well called How to Trade in Stocks by Jesse Livermore. Both are fantastic reads, and I think can really change your life as far as your trading goes. Anyhow, the point being is, you're not going to be good enough, in my view, at least I don't think I'm good enough, to catch every move in every stock all of the time. I like to figure out which way the trend is, if it's a upward trending tape, a downward trending tape, or sideways, and then trade accordingly. If we're in an uptrending tape, I'm in buy the dips mode. If we're in a downtrending tape, I have a sell the rips mode. In addition to individual stocks, and I think this is where a lot of traders get themselves tripped up, is sort of the line from Batman Begins, Liam Neeson, always mind your surroundings. Things don't exist in a vacuum. And let's say you have a stock that's maybe breaking down, but you have a market that's ripping, and you have a global backdrop or a credit backdrop that's positive. So are you looking to necessarily short? Possibly. Would you be doing it in the same size as you would as if the market was cracking badly? The answer, in my view, there would be no. So I always like to have a lot of things lined up for me. I like to have an edge. Like, for example, someone was asking me the other day, I feel like a lot of people are always looking for a formula to the stock market, and I assure you, if there was one, it would be maybe known by now. A lot of it is by feel and experience. So, like, for example, if there's a pullback in a stock, XYZ stock, and it's to, let's say, a 61.8 fib, there's a gap fill there, or there's a trend line there, or a moving average there, or maybe a confluence of a few of those, that to me is a higher probability trade than just kind of willy-nilly going out and trading. So I like to have somewhat of an edge, and I always liked it to be in the direction of the overall market. If it's a sideways market, I'm again trading it smaller. The analogy, anyhow, a little long-winded here, was if you go to like a racetrack, you could win a horse race, but you can't beat horse racing. So like if you went to the track and you had a bead on a horse, you might be able to bet one or two races successfully and win. But if you bet the entire ticket, you're not going to win every race. So what's great about the market is that you don't have to necessarily play every hand. You don't have to play every single setup. If I look at a position, I'm thinking about putting on a position, and I'm sort of undecided on like a stock. If there's no edge to it, I don't force the trade. I'll look for something else. There's so many stocks or so many commodities or whatever. You could always have yourself in a position where you have a higher probability of success. And I'll even be willing to curtail some of my upside in order to increase my probability of winning. That's really what it's all about. Keeping the losses small, letting the winners run, and trying to have more winners than losers. There's no shame in having losing trades. I get stopped out quite a bit. But again, I define my risk and I do my best. Listen, once in a while, everyone gets blindsided. You wake up to some kind of a gap or news that you didn't anticipate. It happens. But knowing how to handle it and how to deal with it is honestly the only way to go. Anyhow, I hope that that's sunk in a little bit. You may need to hear it again. If you haven't watched my risk management video, I can't stress enough. These are lessons I've learned over really a long time in trading now. It's almost 20 years worth of trading. I was into trading in my teens. I had my first brokerage account when I was 18, and geez, time is flying. I'm actually going to work on doing a follow-up to that risk management video. I have some new things I want to dump into there and maybe some updates. But in the meantime, that is a fabulous video, if I do say so myself. I couldn't have done a better job myself. But that video, honestly, if you could watch that and get it down automatically, I think I could safely say that you'll wind up doing better in your trading. Again, there's no guarantees on anything in life, but I would say that if you can really iron down those lessons and you could get them properly, you'll probably start noticing a big difference in just the way you're thinking and the way you're trading. Always think about who's in pain, who's doing well, because underlying conditions and the people who are wrong are your best allies in the market. That said, let's get into it, right? So I have a lot of tickers here that people are asking about. I don't know if we're going to get to all of them here, but we could get to a lot of them. Let's maybe trust my judgment on which ones to do and which ones maybe to skip, and we can talk about the broad markets. So I'm debating which to start with. I think we'll start with the markets, right? That's kind of what I usually do that on here, but I definitely do that in my weekend review video. And the platform is frozen, as is my computer. That is always comforting. We may have to do a reboot here. While we're doing that, we can talk about some other stuff. I actually think we have to reboot the computer. Holy cow! Isn't that annoying? So while I'm trying to get this to happen here, let's hit restart. Let's talk about a couple of things that are happening with regard to the market. Next week we have a Fed decision. That's going to happen on, I believe, the 14th. I think that's Wednesday. So I have a couple of operating theses that I'm looking at while going into that. I'm so glad I had this prepared, because if I didn't, we'd be basically just sitting here doing nothing until this reboots, which it's clearly not doing. I think we may have to do a hard reset here. Anyhow, my thesis going into the Fed is that we all know that they're basically going to hike. It's like almost a 93% probability that the Fed is hiking this cycle. I think what's going to be key with regard to the Fed is the guidance they give. If they are, how many hikes they're projecting going forward. Last year the problem was, and I think the reason why the market kind of had a conniption, was the Fed gave guidance that they were going to hike 4 times going through the balance of this year. They wound up not hiking at all, and they're now hiking maybe for the first time, and that's, again, maybe who knows, maybe they'll surprise the market and they won't. My guess is that they are going to hike. Anyhow, the thesis that I have operating here was a couple of things. One was that I thought that it could signal the low in the bonds if the bonds continue going lower into the Fed. If there's a bit of a rally back, you may get a break that takes us down into support, and that could be the buyable event. I'm sort of thinking it's do the opposite, the Costanza. Like everyone gets nervous and they sell the bonds off, and then it's a kind of buy the news type of an event. I was thinking the same thing with regard to the dollar, although the dollar is now starting to back off a bit. So we may have to question that thesis. I think the reason you got your rally today so a couple of things happened today. Why we had the rally we had was the bonds finally leveled off a bit. You had the realization that they're not just going to continue completely. I had drawn in on my weekend review video a couple of weeks ago. Now we have the charts back up. That would be nice. That they leveled off a bit in this area, this like 119, 121 area. And I think that gave tech a cover to bounce. That's really been what's been weighing on the market. I've noticed a few things also with regard to the internal structures of the market. People are buying stocks and they're shorting futures or SPY as their hedge. Very common, and I think that's the reason why you've seen rallies in stocks other than tech until today, and sell off the last few days in the market. That's what's been going on. That's been sort of my feel of the tape, that it's been a bullish move, but you've had this sort of push and pull because people are hedging. An interesting thing that I noticed on the market today, a few people pointed it out to me. I didn't really want to discuss it too much during the actual trading hours because I was going to save it for this video, but I noticed that the VIX was actually rallying with the market rallying. So that could mean two things, or actually it really could mean three things. One is that the market is now extended and that we are due for a pullback. Very possible. Two is that there was so much call buying, speculative call buying, that raised the VIX off the lows. Very possible as well. Breath wasn't exactly a barn burner today, but hey, you never know. The third option is, again, the one that I mentioned, that people could have been buying stock and hedging their position with either buying SPY puts or buying VIX calls or doing something of that nature. So we should probably find out soon. I got a few messages from people asking today, was the market very extended? The answer is, depends on your time frame. That's often my answer to a lot of questions. We closed, we're currently about 1175 above today's VWAP, which was 2,224.75, although that's a little up in after hours. I think it was like 224 half-ish RTH. So intraday, we are a little bit overbought. True. However, if you go on the daily chart, like let's say we take SPY for example, we're not overbought. Actually, if you look in the weekly, we had a run-up. Last week was a mini pullback, and then this week is really a continuation of the pattern. If you look on the daily, 9-month daily, everyone knows I love the 9-month. Today is technically day one of a breakout, out of a consolidation that lasted 8 days worth of consolidation. And today it was range extension higher. We didn't open on the dead low or close on the, did we close on the exact high? Just off. But today was a fairly decent Marubozu candle. A couple of weeks ago in my weekend review video, I proposed that I thought we were in a up channel. And I posted last night an ES channel, a lateral channel and then a bigger channel. And it wound up being correct. I don't think a lot of people saw that, but I did. I saw it. Anyway, we're starting to reach some levels that I had discussed that people told me I was basically out of my mind. I was delusional. I didn't know what I was talking about. They knew better. They always do. Anyway, we got the 1.272 fib extension that I had discussed in the video of 220.265. The more key one that I've been watching was the 1.618 Fibonacci extension of the last range, which would take you up to 226.53. A little past there, if it were to happen, let's say tomorrow, we would be into the channel high closer to 228. So somewhere in that region should be an area for a decent pullback if it were to happen soon. If you go on a longer term time horizon, a bigger 1.618 fib extension, that would be from like the 219.60 high down to the low of 208.38. You're looking at a Fibonacci extension of 230.60. So we have some big levels coming up on a couple of different time frames. It would not surprise me to see that first 1.618 fib pretty quickly. That's the 226.53. Will tomorrow be the up day? That way it's just straight up? Doesn't have to be. We could have a pullback tomorrow as long as we kind of hold on to half of today's range. Like if there's some early weakness tomorrow, it's better obviously if the weakness is early than later for some type of a pullback. But even if we have a couple of sideways days or whatever, it's still up and out. I mean, the market is at all-time highs. Picking the top is a very costly mistake. And I think that people should be on board with when markets are in uptrends, buying the dips, and when markets are in downtrends, selling the rips. Let's go to IWM for a minute. We had a area that I had discussed getting to that was the 132.68. That was the 1.618 Fibonacci, one of the Fibonacci extensions. And I had talked about another Fibonacci extension up at 151. A couple of things that I want to review here. We got the fib extension, we actually pushed through, and then you had 1, 2, 3, 4, 5 days of begrudging selling, and now that's all taken back with 3 days. You had the trend break, which I highlighted the other day on 12.5, and now we're continuing up. The channel high is, and I remember I discussed this, that I said the market, this would probably get the 1.618. That's a good area to lighten up, but I did think we would see the channel high. The channel high, if it were to happen quickly, lines up really well with the 1.272 of the larger fib range. I'll go over this in the weekend review, don't worry about it. I'm mentioning it more in detail now because I want people to write these levels down, because if we might not be, today's only Wednesday, this could happen tomorrow, as crazy as that sounds. 138.75 is the 1.272 on the larger time frame. It also lines up perfectly with the channel high. And if you remember, I said I thought we could see 138s before this kind of fever really broke. So I like the idea of a right or right out short up there just for a trade. The couple of things that I mentioned when I did my video that I mentioned could be frustrating for shorts is we've had instances where you have these big moves in IWM and then it just grinds higher. You have these small pullbacks, moves up, and it just, but the motion is still higher. That's a very typical pattern for IWM, and I think a lot of people have learned that the hard way in the last couple of sessions. The trend is still up. I am still thinking buy the dip mode. However, if you're long and you're playing long, I like the idea of selling it or taking profits at market past resistance, which is the channel high. Doesn't necessarily mean short, but it definitely means it's a good idea to take some profits. Like I said, the Qs were able to kind of rally a little today. I mentioned in the video, I'm sorry, on the stream today, that I noticed Apple was firming. I like to look at a few things at once, and at any given day, you know, it could be different things that the market is keying off of. Again, it's experience and knowing what is going on in the market to know what those things are. Today, I wanted to see the NASDAQ firm a little, and I wanted to see bonds firm a bit. And I think once people realized that that was happening, it was sort of game on, you know, like the car passes when you're a little kid and you're playing hockey in the street, game back on. So they came for the tech a little bit. And when I noticed Apple firming early, I was looking at the ES chart, and it coincided with the breakout roughly of the lateral channel within the bigger channel, and then it was just, that was it. I mean, it never looked back. It was just off to the races. So you got to look at a few things. You got to, you know, I talk about my market keys. Any given day, one of those could take over. Like today, it wasn't oil. Today it was really more about the bonds and the dollar being down, the dollar pulling back, the bonds having a solid rally bounce, and high yield. Remember, I've talked about this. There are three major components when I look at the markets. My main. There are people who break them down a little bit more. There's really five, I guess, but I condense it into three to keep it simple, stupid. I look at the technicals. Are we trending? Are we going sideways? You know, what's going on there? Within those technicals are internals, are the breadth of the market, the advanced decline line, what the ticks are doing, where the VIX is, that kind of internal motion. Then I also look at the macro backdrop. We know tax cuts are coming. We know that there's going to be fiscal stimulus coming. We know that this is going to be good for earnings, both top and bottom line. We know that American business is now going to be more competitive. Think about Caterpillar. You know, someone asked me, I want to just take a brief sidestep here. Someone asked me today, oh, you know, what's Trump doing, this protectionism, it's terrible. He's leveling the playing field. You know, you have to look at both sides of the coin. In Asia, for example, they're devaluing their currency, and in Europe, like for example, Airbus is subsidized by the governments. In the U.S., we don't have that. Boeing has to fend for themselves, and they have to be up against these currency headwinds. So we're now going to have a system here that is a little bit more of a level playing field. That's a great backdrop for earnings. We're seeing more job growth. Look what Trump did with the carrier deal. Look, he got that SoftBank in here. They're going to bring in 50,000 jobs. These are really, this is going to be the template. You know, a lot of people were saying, oh, he's picking winners and losers, that it's, you know, just a one-off. He shouldn't have done this with carrier. I think he kind of just called them and said, listen, guys, stay. I'm going to do this across the board, and you guys are going to benefit from it. And I think that's going to be used as a template. That will be an enormous boom for GDP. We have gotten like Stockholm syndrome here, where we've fallen in love with our captors here. We're so used to this 2% growth and hanging on every word that the Fed says and terrified about interest rates, because that's the only way that we can go up with PE multiple expansion based on low interest rates. Now we may actually have business improving. You know, I sit here all the time and I talk about the Carnival ride operators, and I talk about, you know, the subpar GDP growth and the lack of visibility. And a lot of the reasons that are cited when you actually look inside these reports are companies saying that they don't know what the backdrop is going to be. The tax structure with Obamacare, new regulations. You've come off an administration that has been one of the most anti-business in ages, and now you're going into something that's going to be very pro-growth. So if the kind of the baseline was 2%, I mean, you've got to think, I've got to think at least maybe Trump can double that. And if we have 4% GDP growth here, and God knows it might even be more, it could go a lot higher here. Keep in mind, and I get this, people said, oh, the AI and the automation or whatever. That is a big theme of mine. And, I love when people lecture me on AI and automation. I was talking about this the last couple of years when no one was talking about it. The answer is yes, AI and automation is going to be a huge problem for the job market, but that doesn't mean we can't have a very nice bounce for a couple of years inside of the bigger down cycle. It goes in stages, and things have been terrible here, and we could have a really rather large counter-rally bounce. It's sort of postponing Judgment Day. The clock has been reset a few years now, which is good. It gives us some time to retrain the workforce. It gives the ability to adjust and adapt to this type of a situation. So that's the fundamental backdrop. The big one that trips people up is the macro, is the more macro view, and that has to deal with, in my view, when I talk macro, I talk about credit. I want to know what's going on in credit. When you get big pullbacks in the market, when you get crashes in the market, and a couple of weeks ago, before the Trump rally started, a lot of people were super bearish, and I kept on saying, look at copper and look at the transports. They're in bull market mode, and the market hasn't responded yet. Those were huge tells for anyone that paid attention. Look what happened with coal. Remember I was talking about, everyone wanted to lecture me about the Mexican peso. I said the tell for Trump was coal. That was ripping huge up. Most people didn't even know what I was talking about when I talked about it. You guys did, because I was pretty clear on that. But the credit situation, we don't have a credit crisis here. You don't see the huge, downtrending moves in HYG. And you're coming from somebody who shorted it also. I had been short, and I talked about cover point. I detailed this in the weekend review video. Go watch that. I don't want to go over this again here. But I had seen a lot of put buying in that HYG, and now it's looking like an inverse head and shoulders breakout pattern. So I was actually looking for a place to re-enter the short, believe it or not, but I was being flexible. I wanted to see kind of certain things that I need to see. There was, again, by the way, more put buying in that today, so I am a little bit mindful of that, and we are into a little bit of technical resistance. But we are over the 50. Today was a move, a gap, and a hold and go over the 50 and 100 MA. So I won't really, like, if we were to be below today's low of day in HYG tomorrow, which was 86.07, really 86s, I would try a right out short, because this to me would have been a false breakout. That being said, until you take that low of day out, now you've got to kind of assume that it's going to be a play for all-time highs again. So, or the highs in the move. So that's sort of what I'm watching there. Without a credit crisis, without forced selling, it's very hard for the market to come in. Look where interest rates are. I know they've gone up quite a bit in a absolute term, but if you go into the relative basis, it's still really strong. It's still basically held. Basically, we didn't even get to the 61.8. I had said I thought we were going to bottom somewhere between 117.39 and 114.80. We bottomed at 117.64. So the lows could actually be in. Like, if we start kind of moving back up now, we could see a substantial bounce, maybe even back to the 129s, maybe even back to the 125s, 126s. That would be great, by the way, for tech stocks. So keep an eye on the TLT. The TLT is sort of the barometer I want to use for PE multiple expansion. The fact that the FANG names were up so much over the last few years, they were the only game in town, and that's why they've been sold now that the rally is breathing. The breath is expanding. A lot of people were saying, oh, it's the crap that's rallying. That's not the crap that's rallying. The transports are not crap. The banks are not crap. The financials, these are not crap. The materials and industrials, you need these things to rally. Otherwise, you risk, the breath getting super narrow like it did in 2007 when it was only in like ag and materials. And then, while the whole market was crashing, and then everything came down. The whole house of cards came down. That is not the case here. Now, breadth is expanding, which is phenomenal for the rally. It's not the junk that's rallying. It's actually high. FedEx is making new highs. That isn't junk. You have Goldman Sachs, by the way. Let's get to some of these stocks you guys want to talk about. Goldman Sachs, by the way, is up $100 in a straight line. That isn't exactly crap, in my view. I will say this. Someone was asking me. Remember I had talked about Goldman Sachs. It started bubbling up under the downtrend line. That's a term that I adopted. It was consolidating, and then it's just kind of gone straight vertical. So someone asked me today, is it too late to buy Goldman Sachs? So I said this. If I was still long it, I'd probably hold it. I don't know if I would first initiate here. One, why? The stock is up $98 straight. The end target that I had painted was 268.57, which is the 1.618 Fibonacci extension of the range. And if you were to, let's say you bought it today and the stock gapped down tomorrow, would you feel really good about your trade location? Buy right and sit tight. Like if you bought that trend line breakout, then you have better location. I can't say that at the high of day after a $100 move you have great location. Does it mean the stock's a short? Not necessarily, but the probability of being right and making money becomes less as you get closer and closer to the target. So yeah, Goldman Sachs is still pretty bullish. I would be looking to buy a pullback, but I don't want to chase the thing when it's up. Even just from the trend line breakout, it's up $40, right? I mean, almost $40. So keep that in mind. That was Goldman Sachs. When would I buy it? I'd probably buy it on either a trend touch or some type of Fibonacci pullback or a retest of the breakout, something along those lines. The backside of the old downtrend line, that to me would be a screaming buy. Often you have these pullbacks, check back to the breakout, and then the continuation higher. That's Goldman Sachs. Deutsche Bank. Someone was asking about Deutsche Bank. I know a lot of people, some people smart, were saying that this thing was basically done. It seems to me that Europe is getting a bit of a stimulus coming now with all of these Brexit type moves, with the Italian referendum. Everyone is all afraid of these things, but I guess I was the only one alive before the European Union, formed. I mean, these countries had much better economies than they do now. This whole globalist movement has like destroyed Europe. So I don't want to get into the, too political with that, but there are reasons. But these moves back to more national situations, I mean, I've said for years, by the way, that the EU is on borrowed time. There's no way you can link currency and fiscal policy without linking governments. And if they're not linking their governments to one centralized government, you have different problems in each country. It's impossible. So, like, for example, Italy has been suffering under the euro. Years ago they had the Italian lira. I mean, it was a joke. It was very cheap. Everyone would go over there. They'd buy all the designer bags. They'd buy all the designer shoes. They'd buy all the designer clothes. Now you go over there, and it was, I mean, only until recently. Now the dollar is more in line with the euro. But, I was over in Italy for my friend's wedding 2 summers ago, and it was $1.43 per year. For the dollar and the euro, it was nuts. I remember I was at a party in Capri in Italy, and the guy actually had the gall to tell me, he's like, I asked how much the drink was, and he's like, it's 20 euros. That's like, I was like, holy cow. It was like almost $40 to buy a drink. It was a very fancy place, by the way, but whatever. The story goes that this is the situation that these countries are in. If they can get their currencies back or get the valuation of their currency down, they'll do the same reason we've been suffering. Take that example, China and Japan, they lower their currency values. It makes their goods cheaper to buy. That's why, like, Komatsu, and that's why China and Taiwan, all these countries make everything, because our currency is artificially high, because they keep pegging it and lowering it. So that's the story. That's really what Europe is now doing. The Brexit is the backdoor way of lowering their currency, which has been held strong because of Germany and countries like that. But it's been destroying their markets. Yeah, I think that actually does a really good a job of it. Anyway, Deutsche Bank, it's interesting how growth is sort of the elixir to cure all. I can't say also higher interest rates. These countries, we here tried zero interest policy. Over there, they went even further with it. They went full tilt with negative interest rate policy, and that I had said it a while ago, and it was very controversial. I said I think that was more what was plaguing Deutsche Bank, the inability to make money. Why would anyone buy the stock in the business? And then they had these fines and things like that. It was just a very negative news cycle. Now Deutsche Bank is kind of ripping. I do think that the move could be up to like 2021. It's probably better to buy the dip in this, but it seems to me like there probably could be famous last words here, maybe through the worst of it. I had been long Credit Suisse. I took some profits in that. It promptly pulled back, but now it's higher than where I had actually sold it. I had sold it when it was significantly higher. It's got a little bit, it's now a little bit lower, but it's now higher. So this looks like it's going to try and fill up that gap. It should probably get to somewhere in the 16s is my guess. That's what I'm thinking with regard to these. I like these all, by the way, for like buy the dips. To me, this looks like almost like an inverse head and shoulders and almost a rounded bottom. So I think that the banks here they're starting to catch on. Those banks are by no means as good as the U.S. banks, by the way. They have tons of crazy shit going on, and they don't have FDIC insurance. They don't have nearly as good balance sheets. So just keep that in mind. However, if there is improvement, those things could start trading like NASDAQ stocks, levered type of situations if things start improving incrementally. But I no disillusion. 200 MA there to me would be the key, as long as it can hold. It's now held it and it's way above it, but I'm liking the pattern is shifting. Higher lows, higher highs. I like that pattern when I see higher lows and higher highs on a leg, and then when I start seeing lower highs and lower lows, that's when you know it's time to go. Higher highs of higher lows, time to go, and then lower highs and lower lows, it's time to go. So that's Credit Suisse. Apple I mentioned the other night, and listen, I'm a big fan of Apple products. I have probably more than I could ever admit. I probably should go to like Apple Anonymous. You know, hi, I'm Justin Pulitzer. I'm addicted to Apple products. But I am not delusional about the stock. It has been massively underperforming the market here. It's looking to me like it could be forming a head and shoulders. If it can get above 112.39, that pattern is negated. And then I think it's sort of safe to buy. It would be over the 50 MA. It would be over the last swing high that off of a higher low, and I would say that the pattern is broken there. If it can break that, it should probably get back up to the 118s and maybe even higher actually very quickly. But I don't want to assume it is going to do that. It needs to do it. So honestly, this is my view. It either breaks 112.39 or this thing is going to revisit 100 and maybe even 95 again. So let's keep it that simple. There's still a big gap to fill down at 96.67. I'm not even eliminating that being the possibility. So that really could happen, believe it or not. So we need to see it clear the 112.39 for the green light. Below there, it's just conversation. Amazon. Let me see. How did this? I wasn't really following Amazon that much today. All right, so Amazon today actually closed above the downtrend line for the first time in many sessions. It has a higher low, but we don't have a higher high, which would mean it needs to clear 792.40, which is also roughly the 200 MA. All right, I'll keep it simple with Amazon. Here's a right or right out trade. I like it long above the 2-day high, which would be above today's high of day, for at least 100 MA touch. Below the 2-day low, it's a short because you have hammers there off of 20 MA, and a violation of those 2-day lows would be problematic, to say the least. Listen, I talked about this thing having the big downturn, the big bounce to just shy of the 50, and then the resumption lower. It doesn't have to play out the same time every way. People are always dogmatic. Everyone, by the way, I have so many people who are like, oh, things, changed or it didn't work out exactly the same way. I don't care if I'm right. I want to make money. So I can honestly, I'll tell you, I've been in situations where I've been short a stock, and within a keystroke, I'm either out and then long. Or the same thing, I'm long, and then the minute I think I'm wrong, I'm either flat or short. When the facts change, I change my mind and my theses. I don't dig in my heels with that. And I'll tell you this, if you can start now making some higher highs, like if you were able to clear the 792.40 and start testing back into the gap again now off of higher lows, I'm guessing you'd probably see that gap fill up to the 818. So, I'm keeping an open mind. Today, like I said, was the first day over. If we're above today's high tomorrow, I think you could at the very least see the 100 MA below the 2-day low. It's a get the F out, or maybe re-short. What else? NVIDIA. Again, this is a situation where there was the pullback. I actually talked about a short trade to the 20 MA. I talked in real time about covering it. Turned out to be prescient because today we made a new high. So that was an example of a trading situation that I saw. I discussed it in real time. We had to close that day. It was on the 11:30 below the 10-day MA. I've been very consistent, by the way, with these. Closes below the 10-day, see the 20. Closes below the 50, see the 100 or the 200. I keep it from. It's really actually been working very well. If you close above or below a major moving average, you get the move down. So it actually wound up happening the next day. People often ask me, do I day trade or do I swing trader? I always assume it's going to be a swing, but listen, if I get the move in a day, it's there. Take it. So it was the backside of one of the channels. It was the 20 MA, and now the stock is back higher. This thing, I would assume, wants to at the very least see $100. I'd be really surprised if this NVIDIA is it's also something that's been working. It's something people have big gains in. They probably want to wait for next year to sell it. It's a winner. It seems like something that people would want to show clients that it's on their book. Something that people might not want to show their clients is this Tesla. I'll keep it real simple with Tesla. I've said for a while, I think that this is an out-of-the-money premium sell, meaning selling out-of-the-money calls or out-of-the-money call spreads, and then selling out-of-the-money puts or out-of-the-money put spreads to do the iron condor or whatever. I think it's just going to be chopping, and I think that this stock cannot get out of its own way until it does two things. One, it gets this secondary out of the way. Elon Musk made a huge mistake, in my view, when he announced that he was going to do a secondary and didn't do it right away. It's sort of like the why are you waiting? Everyone then knows that the shorts know a secondary is coming. They're going to wait for those shares to cover into. And clear the 200 MA. That has been grim death. If you can clear and hold over the 200 MA, this stock will squeeze like a mofo. So that's my story with that. Chipotle. I think Chipotle, the problem for me with Chipotle is that you have a couple of things going against you with this stock. One is you have a lot of, you have bad news cycles. Two, you're going to have a lot of tax loss and a lot of tax loss selling. So you have a 2-day low now. Anything below those 2-day low, like if this bear flags for a couple of days, you can short the bejesus out of it, at least to 252. I mean, this thing could really, the big 61.8 was 312.56. If we can get there, I would probably be looking to sell some out of the money puts because I think that that could be a solid technical low level. And it would be kind of near the end of the year, you get the tax loss selling, and you're down to the 61.8 of the entire move of the stock. So that's the story. I'm really, this is one that I'm not really that interested in. I haven't been trading it that often. That's Chipotle. What else? Caterpillar. Let's keep it real simple with Cat. I thought that they acted really well on the day that they announced that the kind of the reducing of the numbers, and I said we could use that range as the guide, and I've said that I thought this thing could see 105s. Above 97.39 is a long, below 94.05 is a short. I'm just gonna keep those levels. That's the day that they had that wild gyration. It's sort of like a Fed day in my view, or an earnings day. That to me is the key level. Let's try and just get a couple of more here. This Micron, someone asked me about Micron. This looks like it to me like a bit of a pattern reversal, that it looks like it may want to go higher. It has a gap fill up to about 24.02. It seems like it's in a channel. Today was a gap and go over the 10-day, so I guess you could play long against today's low of day. Back below today's low of day, this would be a faker move to me. And I think we would see at the very least the 50 MA and maybe even the 100 MA. So that's the story with it. I actually put on a small call spread today to play for the gap fill here. Very small. Not even so much to make so much money on the trade, but kind of just to be in it and to have an idea of the options. Above today's high tomorrow should at the very least see the channel high, which is up in like 21.5-ish area. That was Micron. I covered Deutsche Bank. Under Armour. This was one I kind of warmed up on a couple of days ago. I noticed on the 12.2, that's a look below and fail move. You had to look below the range, it closed back up, and then the next day was over the high. It was a bit of an inconclusive day, but it's been rallying since. I think this is going to want to see the 50 MA. It'll be where the gap starts. I don't know that we'll fill the gap, but I think we'll get to the top of that range. It's about 33.90 or wherever. We'll see how that goes. I'm now, by the way, using UA. UA is dead to me. We're into UAA. That's the voting shares. It's kind of like Goog and Google. I go with the L. So yeah, that's the story with Under Armour. Shake Shack. I've been playing this. I'm short some puts. It gapped on the earnings and it kind of has been a fade. Today, you have multiple days of hammers. Today closed just below the 200 MA. So if you can clear the 200 MA, I think that this would probably have a rotation back up to probably 38s. I'm fine with this broke out from the 50 MA, so it needs to hold the 50 MA. As long as it holds the 50 MA, I'll keep my short puts. If it starts closing below there, we'll probably get the full gap fill. But this stock tends to trade in a range. When it gets into like the lower 30s, 32 and below, it's a sell puts. when it starts getting up into like 38s to 41s, it's take them out, take them off. That's the way I've been playing it. I've been playing it that way for the better part of 2 years, and it's not always been the easiest trade or the prettiest trade, but it's been a profitable one that I've done multiple times. Twilio, one of the new silliness stocks, Silliness 2.0. I had been big time on board with Twilio for 65.94, which was 2 times the range. After that, I said not to look back. Then we talked about a little bit of a bounce trade, but today it's stalled on the 10-day MA. Yeah, I mean, this thing to me looks like it. I can't tell you where it's going to bottom. I'm sure there's a ton of losses now in this thing. Maybe it gets back to the 23s. Maybe even makes new lows. Who knows? But you need to clear the 10-day MA at the very least, in my view, to get back bullish. If you want to play a right or right out trade, it would be a move over the 10-day for maybe a move back up to like 41s, $10. Cleared that one off the plate. Palo Alto, not one I look at that often. This whole sector has been out of, again, this is like a Chipotle. It's got a ton of people who are underwater with this. I think that it's going to need to get the tax law selling out. You have multi-day consolidation here. I wouldn't want to first short it here, but if there was a decent bounce, maybe. I think that this may want to see $100. It held the 50% fib a couple of times. The 61.8 is down around $100. Maybe, we'll see. Again, this would be something that I'd be looking at more next year. The BABA, maybe we'll end here on BABA. It's just holding trend here. You have a kind of a bit of a bear flag forming. If there was a break of the 1, 2, 3, 4, 5-day lows, I think you'd easily retest the old lows and probably see the gap fill down to 87.30. 86.42 is really the breakout. I don't necessarily know if it would stop there. I mean, I could even make the thesis that this thing will see 78s again. This tends to be a stock that runs into that singles day. It wound up even selling off ahead of there. I'll keep it simple. You have the bear flag constitutes 1, 2, 3, 4 days. The high of that was 91.93. Above there, it can probably rally a bit above. But if you start getting below 89.18, it will be a short. Anyway, that's my story. I'm sticking to it. I think we covered some solidness, some solid stuff. There was something else I had wanted to talk about. I promised I'd talk about Zillow Group, right? This is one I've been a pretty big bull on. Again, this is another one that I've played and traded pretty decently. It's to the backside of the old uptrend line, so if it's going to stall, it probably would be soon. You have a gap fill a little higher up to 39s. I like playing against today's range. So above 38.48, because this was the kind of the pullback consolidation of the range. So below 36.83, I'd probably close my short puts. Some of them. I have a longer term thesis on this stock. I think a lot of people think it's only about real estate prices. This is like the Google of real estate. It's a monopoly. Every broker basically uses it, and it's a subscription service. It's sort of like, almost like a Netflix type of a situation. I think at some point, I don't know how Google or one of these companies, Microsoft or someone, hasn't snapped this thing up. It is ginormous. It's a great business. I like it. So I'm a big fan of buying this stock on dips. I had been playing it. I buy gap fills. I actually happened to sell puts on this at the low of the recent pullback. Just sort of more on it was actually a front ran the gap fill a little, but I think it's because I had placed the sell order for the puts roughly at what the price equivalent would be, and I think you had the IV pop enough that it triggered them, so it wound up being okay. If you want to play with shares, I like it above today's high. If you want to play it long, or if you want to play it short below the low of day, probably would get a quick move back to, at the very least, 35.21, potentially even the 50 MA. I like Zillow. I don't really see too much in terms of caution if it's above 36. So we'll keep it that simple. Above 36, I'm still okay with it. But if you're looking for a kind of a quickie trade, above or below today's range would do it. That's my story. I'm sticking to it. If you missed this video, or you want to watch it again, which I always encourage, it'll be on my YouTube channel very shortly. That is Justin Pulitzer Trades. If you're not following me on Twitter, I don't know where you've been. It's at Justin Pulitzer. Let's have a great rest of the trading week. I will do a special Fed edition weekend review video this Sunday ahead of the Fed meeting. And then next week, next Wednesday, I will do a post-mortem after the Fed and tell you what's really up with that. So let's have a great rest of the week, and cheers.